Goldman Sachs has just released a report which predicts that the S&P 500 will only give a 3% average return over the next 10 years. This is of course quite alarming, given that over the past 10 years, the S&P 500 gave 13% average return, which means that this 3% return would be a huge decrease in returns. In this video, we will be looking at how Goldman Sachs came to this conclusion. Will we really see such a low return, or are they wrong about this? Then, I will also be sharing what's the best way to invest now, knowing that the S&P 500 might give a lower return in the future. But before I start, do join my 10,000 members Telegram chat group to discuss or ask any questions that you might have. Okay, Goldman Sachs didn't exactly say that the S&P 500 will boom and only give 3% returns going forward. Instead, they gave a range of likely outcomes, which ranges from negative 1% annualized return to 7%. So the 3% is just the middle point, yeah? Besides that, they also think that there's a 72% chance that the S&P 500 will underperform bonds during the next decade, and a 1/3 chance that the US stock market will give a lower return than the inflation rate. Though, to be fair, there aren't the only bearish bears out there. Just 2 months ago, Vanguard forecasted that the US equities would only give around 4% average returns over the next 10 years. Fidelity isn't too far off either, where they expect only 5.7% average returns over the next 20 years, while JP Morgan forecasted annualized returns of 6.7% over the next 10 to 15 years. So what's going on, and why is everyone so bearish? Everyone except for Mr. Lu from 1M65, of course. Goldman Sachs gave 5 reasons, so let's go through them. First, the US market is currently at a high valuation, which implies that future returns are likely to be lower. Now, most people would probably agree with this, as the US market seems to only keep going up recently and making all-time highs after all-time highs. And even when there's a sell-off, it tends to immediately come back like the Terminator who just can't seem to die. If we look at the S&P 500 cyclical adjusted PE ratio, right now it's at 38 times in the 97th percentile. This puts it at one of the highest valuations it has ever been over the past 100 years. And historically, whenever valuations are this high, we would typically see lower returns in the subsequent years. A study by Yale shows this phenomenon nicely. This chart shows how the PE ratio of the stock market, represented by the x-axis here, affects the annualized future real return of the stock market, represented by the y-axis here. You can see that when PE ratios are low, there's a much higher chance of getting a higher future return. Conversely, when PE ratios are high, such as right now, there's a much lower chance of getting a high future return. And in some cases, we might end up seeing negative future returns. Currently, the S&P 500 is around the 28 PE ratio, which historically isn't too great for the stock market. Though, I would like to argue that just because a valuation is high, it doesn't mean that the stock market will automatically perform badly in the future. That's because if we look at the S&P 500 profit margins, it has gone from 7% back in the early 2000s all the way to 12% now. Not just that, earnings per share has also improved. So ask yourself this, if the S&P 500 is well supported by the fundamentals, would it be reasonable to expect a higher valuation from it? Something to think about there, yeah? Quick pause. With markets giving high returns over these past few years, and with more interest rate cuts around the corner, there's no better time to start investing than right now. But if you're afraid of starting now, especially at all-time highs, no worries. That's because Mumu has a strategic partnership with Nasdaq to host the global US stock simulation paper trading competition, which offers you a fun and risk-free way to learn how to trade US stocks. You will start with $1 million in virtual funds, and as long as you have a positive returns every week over 5 weeks, you will win a share of $100,000 rewards with other winners. Top 3 winners in your local region will win up to $1,000 in stock cash coupons, while the top 3 global winners will win up to $10,000 while getting featured at the Nasdaq screen in New York Times Square. And the best part, participation is completely free. All you need to do is use my link to register for the competition, and you'll get a 1-month additional access to Nasdaq Total View market data that's worth $25.99. valid for 62 days. New users will get to earn up to $1,034 worth of welcome rewards. Plus, both new and existing users will get to enjoy zero commission for Hong Kong stock trading for 30 days. For more details of the promotions, do refer to the link promotion page in the description below. The second reason as to why Goldman Sachs is bearish is because the market concentration is at one of its highest it has ever been over the past 100 years. Right now, just the top stocks alone take up almost 1/3 of the entire S&P 500. And in the first half of this year, these 10 stocks alone contributed to 74% of the entire index's return. Goldman Sachs found that it is extremely difficult for any company to maintain high levels of profitability over long periods of time. So when you have such high concentration in the index giving such high returns, you run the risk of some of the top companies slowing down and bringing down the entire index together with it. For example, stock concentration was high in the 1960s and early 1970s. These were the Nifty 50 stocks like IBM, Kodak, and Xerox, which dominated the S&P 500, but they eventually crashed in the 1970s, and the S&P 500 entered into a lost decade. The same thing happened in the 1990s, where internet-related stocks ran too far ahead of fundamentals and ended up crashing when the dot-com bubble popped. Again, I would like to point out something here. Even though all crashes look the same, the cause of each crash is always something different. For example, while it's true that back in the 1960s, the Nifty 50 group dominated the index, but it's also true that they were a much less exclusive group as compared to the Magnificent 7 stocks that we have right now. Many of the companies back then ran ordinary businesses rather than dominant ones. In contrast, the top stocks that we have today have huge moats, dominate not just in the US but in the global market, and have high levels of profitability. Not just that, throughout the last several years, the Magnificent 7 stocks showed higher profit margins while delivering higher earnings growth as compared to the rest of the stocks over the last few years. This again shows that the rich valuations of the S&P 500 are well supported by its fundamentals. And the good news is that as interest rates come down, investors are starting to move away from just the top few stocks and are looking towards investing into other stocks that may offer better value. This is also known as the broadening of the stock market, where the rest of the stocks are starting to play catch up. This means that the risk of the top stocks crashing the entire market will go down as well. Third, Goldman Sachs expects the US economy to contract more frequently over the next decade. Specifically, the US would see 4 GDP contractions over the period, or in 10% of quarters. Now, I have 2 things to point out here. One, historical data by FactSet shows that GDP growth has been a poor indicator of corporate earnings growth. This is because almost 30% of S&P 500 sales now come from overseas, as compared to just 5% 70 years ago. So whatever happens in the US will have less of an impact on the S&P 500. Instead, data shows that the growth of the S&P 500 earnings per share now correlates more to the global GDP growth rather than the US GDP growth. Second, there is absolutely no way to predict what will happen to the US economy in the future. If it was this easy, it would have been priced into the market already. Even the Fed, who have the most up-to-date data on the economy and hundreds of economists working for them, don't have a clue what will happen 1 to 2 years from now. That's why they always choose to wait for a series of data to see how things turn out before they take any further action. And for Goldman Sachs to come out and say that the economy will see 4 contractions over the next 10 years is like predicting whether your Cai Fan auntie will call you 帅哥 tomorrow or not. Maybe she will, maybe she won't. Fourth reason, Goldman Sachs sees that corporate sales and earnings growth for the biggest stocks will decelerate in the future, and this will impact the entire market's returns. This ties back to the earlier reason for the high concentration in the market. Now, I don't know how they predict company profitability will go down in the future because I don't have access to the report. But according to analysts' forward earnings forecast, they expect future earnings to continue going up. Not just that, the beauty of the S&P 500 is that its holdings change over the years. For example, just 10 years ago, companies like ExxonMobil, General Electric, Chevron, IBM, and Procter & Gamble dominated the top. But now, almost all of them have been replaced by bigger and better companies. This is what pushes S&P 500 to consistently do well. And I'm quite sure that in 10 years' time, we will see a totally different top holdings than we have right now. Because of that, I don't see how Goldman Sachs, or anyone for that matter, can predict what will happen to the company's earnings in the future. Lastly, Goldman Sachs notes that Treasury yield is giving a 4% return. Their reasoning is given that the Fed is expected to cut rates further, investors may look to invest their money into Treasury bonds that can give a risk-free return of 4%. Personally, I feel that this has always been the case, where investors who are risk-averse would invest into bonds, and those that are okay to take on more risk will invest more into the stock market for the potential of a higher return, or something known as the equity risk premium. For investors to want to invest into bonds instead of the stock market for returns, something drastic must have happened to the stock market to make it less appealing. Like in the 1970s, when the stock market crashed hard due to the inflation and interest rates rising too fast. Otherwise, in normal circumstances, most long-term investors will still continue to invest into the stock market for the higher potential return. Not just that, given that we have a record $6 trillion of money sitting on the sidelines now, investors are ready to buy the dip whenever they can. This is also why the S&P 500 has been so resilient this year, and every dip was followed up by a quick rebound. So, those were the 5 reasons given by Goldman Sachs. Personally, based on the data that we have seen, I'm a little skeptical that we will see the S&P 500 giving an average of 3% return over the next 10 years. Add in the fact that Goldman Sachs has been consistently wrong so far, I have an even harder time believing their prediction. Though, to be fair, this problem isn't unique to just Goldman Sachs. No one, and I mean no one, can really predict the stock market's performance with any accuracy, as there are too many factors involved and the world is dynamic with unforeseen events, which results in unpredictable impacts. For example, if we open up Vanguard's 2014 report, it says that because the current market valuations have increased and because interest rates are lower now, we expect that the S&P 500 will underperform its historical average of 10%. And here, they predicted that the S&P 500 will only give around 6 to 7% average return from 2014 to 2024. As it turns out, the S&P 500 saw one of its best decades ever, giving around 12% compounded growth rate. During that 10 years, we saw multiple market crashes, a once-in-a-lifetime black swan event, and a rise in geopolitical tensions. Which brings us to the question, knowing that it is impossible to predict the future and there's a possibility that the S&P 500 might just give lower returns over the next decade, how should we invest our money then? The short answer is, we don't have to do anything special. Instead, all you need to do is keep investing as per normal. Here's why. 1. As mentioned earlier, the market won't automatically crash just because it is at all-time highs. Instead, all-time highs tend to lead to more all-time highs. In fact, if you invested only during all-time highs, you will get higher returns as compared to investing on any other days. This sounds counterintuitive, right? Like, shouldn't the market revert to the mean once it has gone up too much? Not really. You need to think about why stock markets are able to reach all-time highs in the first place. Yes, part of it is due to FOMO and greed. But the other part is driven by higher company earnings and improving profitability. Which brings me to the second point. All you need to do is consistently invest over the long term. Just now, we saw that when PE ratio is high, future returns will be lower, right? This is just the distribution over 5 years. But the longer the period, the more converge the returns until they eventually converge at around the 10% return. This shows that no matter what the PE is, as long as you can buy and hold over the long term, you will be able to do well. Lastly, if you are still worried about the S&P 500 giving lower returns in the future, the solution is pretty simple. Just invest globally lor. That way, you won't have to fully depend on US companies to give you a good return. And if anything, fund managers themselves think that global equities will perform well over the coming decade, which could help to balance out the lower returns from US equities. In short, we shouldn't just blindly listen to market warnings online, because all we need to do is invest consistently no matter what. Market up, you buy. Market down, you cry a bit, then you buy more. And over the long term, you will do well. Anyway, that's all for this video. Hopefully you found it useful. Like, share and subscribe as I'll be posting new videos every Monday, Wednesday and Friday.